Hey everybody, I hope everyone is doing well and had a good day. This is the overview of the Emini 5-minute chart for Friday, November 1st, 2024. And because it's Friday, we will look at the weekly chart first. The market often tries to do something to alter the appearance of the bar at the end of the bar, and in this case on Friday to influence the weekly chart bar. So weekly support and resistance becomes more important later in the week, especially on Friday. It's a little bit tricky because we can see the bar, but overall, the market has been channeling up, and we can count 3 legs here. We can count 2 or 3 legs here. 1, pullback, 2, pullback, 3, and then a bear bar closing below its midpoint. I think a lot of traders will get out below a bar like this if they're long, because if you think about it, think about the trader's equation. If you're buying up here, you're buying anywhere up here. Your stop's down here. In theory, you buy the close. You need momentum to continue right away, and that's a disappointing bar, and that is not momentum to the upside. So it's a possible nested late leg, and you're getting a reversal. So a lot of traders will get up below this bear bar. However, if we think through the market cycle, we have a nested spike and channel trend. I'll demonstrate that. So we have, you can say over here, a spike, pullback, and this entire rally is a channel. But even right here, we had a spike, pullback, and a channel. And the start of this channel, it's minor, but it's right here. And we turn on snap mode. So right here, the bottom of the pullback is the start of the channel, and channels evolve into trading ranges. And the bottom of the channel, the start of the channel, often becomes the bottom of a trading range. And this will be a test target, a magnet, because this is the start of two-sided trading. If channels evolve into trading ranges, the upside is more likely limited and will come back and test the bottom of the range. So a couple of reasons for bulls to get out here and for us to come down and test down here. Now, the risk for the bulls up here, if you're buying here, you're buying consecutive bear bars, and I see the argument. We sold off, rallied, sold off, but it's a 3-bar micro channel. It's probably going to get a second leg down, and if you're buying here, betting this is the bottom of the trading range, you can do that, but you have to assess the momentum and the leg count on the way down. And some traders see this sell-off as leg 1. And again, the danger for the bulls, calling this the bottom of the range, is that in reality, this entire pattern is a spike in channel. So the bottom of the channel could be all the way down here, could be all the way down here, and it could be here as well. But the point is, it can be lower. And the last thing the bulls want to do is put a stop down here, or here, or here, and hold long, because these are buy zones. Traders are going to buy below these swing points. So a lot of traders will get out, be quicker to get out of longs, and look to buy lower. And because of that, bears will sell. So let's look at the daily chart going into the day. We had a trend day yesterday. Breakout of a tight trading range. What's the problem with trend bars? In general, you're expecting 1 to 3 bars sideways after a trend bar. Climaxes typically pause and the market decides if they're going to continue or reverse. Now, we have a breakout of this triangle up here, tight trading range, but we're still within this trading range over here. This is sort of the possible bottom of the trading range I was talking about on the weekly chart. It could simply be a sell vacuum to the bottom of this range, and there is a way to see 3 legs down, or even just 2, 1, 2. So possible second leg trap to support. So there's reasons for this trend bar to stall. And in general, so after a trend day, the expectation on the next day, let me rephrase that. After a bear trend day, the expectation is sideways to up after beginning by the start of the second hour of the day. I want to make sure I'm being clear with that because I talked about this in the past and it wasn't clear. After a bear trend, the expectation, it's unlikely to get another trend day back to back, follow through selling. What's most likely, even if we sell off for the first couple of hours, the market often goes sideways to up, beginning by the start of the second hour. In this case, we just went up from bar 1. So let's get into the 5-minute chart today. The market gapped up, and we had consecutive bull bars on the open, probably always in long on the close of bar 1, certainly by the close of bar 2. We look at bars 1 and 2, and that's a strong bull breakout, probably needs a second leg. Now, the risk, this could be an expanding triangle. And, you can start it from wherever. We're getting lower lows and higher highs. So the risk for the bulls buying here is that they're buying at the top of an expanding triangle trading range. But then look at bar 3. Is bar 3 a strong sell signal bar? No. It's a gap up with follow through and a doji on bar 3. There's probably more buyers below 3. And that's what we got. Is our bars 4 through 4 and 5, maybe 6 and 7, is that the second leg up? 1, pullback 2. It's not very symmetrical. It's a much smaller second leg. The market often does that. You'll get a breakout that gets a brief second leg, then a deeper pullback, and then a more symmetrical second leg. And you see that all the time. So in this case, this rally is strong enough for a second leg. Bar 7 was an outside bar. Outside bars are trading range bars. They're expanding triangles. We attempted to break out to the upside, and then we attempted to break out to the downside. But we're still above this higher low. And you can see what happened. Traders bought the close of 7, and on bar 8, we got another bull breakout. Probably by the close, and let me just forgot to add yesterday's high, and I think that's important. Most bars are breakout bars. Look at any chart. Price action is fractal. Doesn't matter if we're looking at the daily chart or the 5-minute. Most bars are breakout bars. What that means is most bars go at least one tick above or one tick below the prior bar. Just look at this chart from bar 1 today. You can say bar 1's a breakout bar, but let's start with bar 2 because they gap up. But bar 2, it's a bull breakout. Bar 3, bull breakout. Bar 4, outside bar, breakout, bull breakout. Bar 6 is the only non-breakout bar that we can see today on this chart because it's an inside bar. So the point is, most bars are breakout bars, and because that is a first principle and that's something that is true on all time frames, you can expect the market to break out above or below the prior day's high or low. That's why I always keep an eye on where the prior day's high and low are. So earlier in the day, I thought we'd probably go above yesterday's high, the blue line up here. So probably by the close, it's always in long, still always in long through here. Traders are buying. But then we get bar 12. And bar 12 is problematic for a couple of reasons. We rallied, paused, rallied, paused, rallied again. It's at least 2 legs up, maybe 3. And we're at the top of yesterday's range. We're testing that inside bar from bar 3 yesterday, and we got 1 bar above it, but could not get follow through. So a lot of traders who are long up here, in theory, they have a wide stop, probably below bar 7, and it doesn't matter if you bought down here or the high tick up here. If you're willing to hold long, then you're willing to buy up here. And if you're willing to buy up here, stop down here, your reward equal to your risk is all the way up here. And we have not even broken out above the prior day's high. And we might be high in a trading range. So whenever you have a possible second or third leg high in a trading range, if you're buying, you need momentum. because that is your high probability. As soon as the momentum disappears and we start to go sideways, a lot of traders will start to bail out of the trade, and that's what we had here. Some traders will exit during the bar. So when bar 13 disappoints, they will just exit soon after the bar 12 close. Others, they'll just get out below 13. But 13, in my book, is a GTFO bar. Consecutive buy climaxes far above the EMA, and you get a bear bar closing near its low. Just get out below it. Now the rally, 2 legs up, strong enough for a second leg up. But then we got 13 through 16. That's a little bit of a surprise. Much deeper pullback than the bulls wanted. And if we go from the bar 7 low to the bar 13 high, and we think about that bull leg, the market pulled back almost 100%, probably pulled back 90% there. And just think about that logically. Does the market pull back 90% when it's trending? Of course not. The answer is no. The market pulls back 20 or 30% when it's trending, and it keeps traders chasing the market, and it's trapping traders out who want to buy, and it's trapping traders in who are selling. But if you sold above bar 7 and had a wide stop and scaled in, you would have made money and you avoided a loss on your first entry. And that does not happen in bull trends. So at this point, probably by bar 15, the market is in a trading range. And what do traders do in trading ranges? They buy low, sell high, and scalp. So down here, we have big up, big down, big confusion. The market is likely in a trading range. The bulls need a second leg up, and the bears need a second leg down. That creates confusion, and that creates deep pullbacks, and typically the market starts to go sideways, and you usually will get a triangle. And in this case, we rallied for 3 or 4 legs up. You could say we rallied on 16, pause, 19, pull back, 22, pull back, 24. And let's think through stop orders. If you sold 1 tick below 13, you made money. And stop order traders typically don't make money. Most breakouts fail, but this breakout was successful. You sold 13, stop above, you made several times your risk. What's going to happen when we retest up here? We have disappointed bulls who bought the close 12, and we have traders who did not sell 13, missing a good sell. So that creates an imbalance. There's sellers above up here, disappointed bulls, and bears eager to short. You get 3 or 4 legs up to the top of a trading range. Traders are looking to sell up here. So a reasonable sell in this area. Sell for whatever reason you want. 3 legs up, high 1, 23. There's probably sellers above. Stop order trade below 25. Reasonable stop order sell. And then we got a bear breakout. Now you can say the bulls got a second leg up. It's sort of the minimum. We did not go 1 tick above the high of 13. And typically, breakouts, the minimum expectation after a breakout, the market goes 1 tick above the breakout's high. And same with the opposite. Bear breakout, pullback, you expect to go 1 tick below the low of 16. At this point, we have 2 legs up, 2 legs down. The market is confusing and entering a tight trading range. But this bear breakout, we have a 6 or 7 bar bear micro channel. That needs a second leg. So traders will sell above, looking for a second leg down. And then we got bar 37. Now, 37, probably an always in flip. What I mean by that is if you're short, you get out of shorts above 37. And if you're flat, you can buy above 37. But look what happened. The market did not trade above 37. Whenever there's a reasonable buy and the bears prevent the reasonable stop order buy to trigger, it's a sign of strength by the bears. So we did not trigger the buy. We got bad follow through for the bull breakout, 37, sideways, 38, and then everybody sold. And 39 is a strong enough breakout for a second leg down as well. And think about what I said on the daily chart. I'm thinking about it right here. 37, bull trend bar, 1 to 3 bar sideways. 39, bear trend bar, 1 to 3 bars sideways. You just see that everywhere. And that's because price action patterns are fractal. Price action is price action. It does not matter the time frame that you're looking at. Starting to get a fairly tight bear channel. Lower highs, lower lows. But 45, I think 45 is another place where always in traders, bears look to exit shorts above 45. Bulls might buy, taking a chance. But look at the rally up to 48. It's problematic. 45, decent bull bar, but almost totally overlapping the prior bar. So that's big down, big up on a smaller time frame. And then a smaller follow-through bar, 46. The bulls want a follow-through bar equal in size to 45, if not bigger. So we got a big bar, a smaller bar, then a bigger bar, another smaller bar. There's problems with this rally. It's a couple of legs up on a smaller time frame. You also had a bad stop order signal bar, 38. Look what happened. Bad stop order signal bar, traps traders, 39, gets followed through, a second leg. The market retests that price, and you have bears who did not sell below 38 because the signal bar is weak. And you have bulls who were long for any reason, or maybe they bought below 38, betting 37 would get a second leg up, and bulls and bears are trapped on 39. So when we retest this price level, we have sellers in this area. 49, bear breakout, a little bit of a surprise, not overlapping bar 48 by much, and that traps traders. 5 bar bull micro channel, bad signal bar for selling. There's trap traders below 48. That's going to get a second leg down probably 80% of the time. So traders look to sell. Now, it is a problem that we had this micro channel. There's probably buyers below. And you can see we fell below there, but started to go more sideways. The bears had 3 legs down, spike in channel, and then we ended up pulling back. It looks like we tested the midpoint of the bar. So look at this is the midpoint of bar 49 over here. Market came close to it. That's the sell zone, the beginning of the sell zone of the bar. The sell zone of any bar is the upper half. The buy zone is the lower half. Doesn't matter if it's a bull bar or a bear bar. Traders would prefer to sell in the upper half and buy in the lower half. And I have some trade management things. I'll talk about a few trades I took. And there's something interesting in here. Over here, 59, probably going to get a second leg up, strong enough bar, and 3 legs down might be the bottom of a trading range. Overall, it looks like a trading range. A couple legs up, a couple legs down, lots of overlap. And the bulls, sure enough, they get 2 or 3 legs, 1, 2, 3. But now you have a climactic bar, 68, might be a late leg, 50% pullback of 49. There's reasons to sell up here. This is probably all one leg, one breakout on a higher time frame. If we think through the 15-minute chart, every third bar is the close of a 15-minute bar, and that's why I like having the every third bar numbered. So from the open, or you can say the high of 49 to the low of 51, that is 1 bar on the 15-minute chart. That's a strong looking bar. And then we got follow through and another follow through bar. And that creates sellers above. Think through the market cycle. 49, bear breakout, implied pullback 50, spike in channel trend. Channels evolve into trading ranges. And the channel that I'm talking about, it's small, it's minor, but it's right here. Spike in channel trend. Channel evolves into a trading range. That's what we got. And sure enough, there were sellers high in the trading range. We try to break out, get bad follow through, high 1 buy, but bad context for the bulls. And the bears still probably will get a second leg down. It's just a big leg 1, leg 2 pattern on a higher time frame. You can see it up here in the top right of my screen. Leg 1, 2-legged pullback, leg 2. So there's a stop order sell below 71. and the market sold off to a new low. And there's something interesting. I could have mentioned this earlier, but bar 1 remains the high or the low of the day, only about 20% of the time in general. And when it does, it's typically a trend day, trend from the open. And it could have happened, on bar 12, it looked pretty likely that bar 1 could remain the low of the day. But when we get this deep pullback and start to go sideways, it becomes more 50-50. And the lower we go, the more likely it becomes we're going below bar 1. So I thought that was a test magnet, and we sure enough got there late in the day. But buyers below, bottom of the range, breakout point bar 79 the prior day. The market also tested that, tried to break out below, but failed, and we just went sideways there into the close. So let me see if I can remember some trades I took. Today was not a great day for me. I really overtraded, and I didn't follow one of the most important rules, which is to not trade when the market is in a tight trading range. So I also overtraded, but that's due to the fact that I was trading in a tight trading range. The problem with tight trading ranges is that I just get too many signals, and the signals are just too minor. And it can be tough when you can see what the market is doing, and there's this, and I'm speaking for myself, but there's this desire to participate when you understand what the market's doing and you want to take trades, even if it's a tight trading range. But the reality is it's not really worth it. So let me think back. I'm not going to mention every trade, but I'm going to think about everything I did. I know I bought the close of 8. I could have bought down here, but I ended up buying the close of 8. And then I bought the close of 9 after 10 rallied and pulled back. I bought a retest of the close of 9. And I got out shortly after the close of 12 because we started to stall. If I hadn't gotten out, I would have exited below 13. Through here, 18, 19, thought that would get a second leg. At this point in the day, I thought we would get above the current high of the day, what ended up being the high of the day. And I pulled up a 1-minute chart to get a stop order trade. And it was somewhere between 20 and 21. I got long, somewhere in here. And I scalped out, but then I bought again at the high of bar 20. It's a bad buy signal. I got long again during 22. I think that was a mistake. I probably should have bought in the buy zone of 21. We pulled back deeper, and I was long during 24, but I got out shortly after the close of that bar because we were not racing up, and we had many legs up to the top of a trading range. I did not sell in here. The next thing I can remember, I bought above 45, taking a chance. And this was a mistake. And this was my biggest mistake of the day. I bought above 45 and exited shortly after the close of 48. This was disappointing. This is not really what I wanted to see. I probably got out around here. Now the problem is that I was thinking through the spike and channel, market cycle here, 39, spike, channel, trading range. So the high of bar 40 becomes the top of a trading range. It's minor. But I thought I would buy because we broke out and got followed through above. Looking back, really weak breakout and bad context. It's either high in a bear channel or high in a trading range. But I bought here, and I also bought more at a 50% pullback of the rally. And I bought more here. But the way the market reacted here, it was not doing what I wanted it to do. It was really not bouncing. I wasn't getting support. And I got out somewhere in here fairly quickly. And I think that was the last trade I took. But we can go through stop order trades. You can buy above 1, 2, high 1, 4, buy the close 8, 9, 10. Any of these bars really, but you got to be quick to exit. Aggressive, but you can sell below 13. I thought 25 was reasonable. 18, I didn't love 18 because I thought this needed a second leg down, and I thought there would be a deeper pullback. So I don't know about buying 18, but buying a pullback I thought was okay. 25, reasonable sell. Hard to trade in here, really tight trading range, and contracting triangle. And this is a really common pattern too. Whenever you get a breakout of the triangle, first of all, triangles are breakout mode, 50-50 probability, roughly, so 50% chance. You get a bull breakout, 50% chance you get a bear breakout, and 50% chance the first breakout fails and reverses. Bear breakout of the channel, or the bull trend line in this triangle, 39, with follow through, but the market still pulled back and tested the apex of the triangle, and then we got a second leg down. Stop order buy above 45. Hard to buy in here, very tight trading range, and right below the moving average. Stop order sell below 71, and that's probably it for the day. Limit order trades, buyers below 3, bad sell signal after a bull breakout, buyers below 6, inside bar, and strong enough bull breakout for a second leg, probably a minor reversal. There's a limit order sell at the 13 low or the 12 low. Anywhere in this area, traders are going to look to sell, and especially after 2 or 3 legs up to the top of a trading range, reasonable to look to sell. So traders will sell above bad looking buy signal bars 20 and 23. Probably sellers above 30. It's a bear micro channel. It's a breakout. First reversal up, probably minor, probably going to get a second leg down. 36, bad buy signal. Traders will sell above it, but they'll probably get out above 37 if it triggered. Limit order sell in here because of the midpoint of the triangle or the 50% pullback of 39. There are also buys over here if you, again, think through spike and channel evolves into a trading range. The bar 7 low or the bar 4 low could be the bottom of a trading range. So traders will buy in this area. Tried to break out 44, reversed 45 for at least a scalp. Limit order sell above 52. That's a bad buy. A bad buy is a good sell. A bad stop order buy is a good limit order sell. A couple of legs down. Traders buying below bars down here, betting it's a late leg and will evolve into a trading range and test somewhere back up here. Limit order sell above 50, bar 50. And that didn't trigger until all the way up here, but it was 3 legs up, reasonable to do. Bad buy signal bar 74 after a bear breakout, which will probably get a second leg down. It's also nested, leg 1, pullback, leg 2, leg 1, pullback, leg 2. Traders will sell above 74. And then just sideways into the close, limit order market, sellers above bars, buyers below, but usually not worth trading in the final 10 bars or so. The day type today, we had a trading range day, mostly horizontal, but really we had a couple of legs up in a fairly tight bull channel, and then we had a more broad bear channel for the remainder of the day. And where do we go Monday? The bears had a breakout, and they got minimum follow through. Look at the Globex session. So if we look at this chart, they actually got a bull close for the follow through bar, and that's disappointing for the bears. So bear breakout attempt, but no follow through, and an inside bar. And there's probably buyers below today's low, Friday's low. It's also a bad stop order buy and because of that, traders will sell above the high if we get there. So probably sellers above and buyers below. We are possibly at the bottom of a trading range here, and the bears, they got some momentum here, but then the momentum disappeared. It looks like bears who sold up here are taking profits. Bulls might look to buy, hoping this is the bottom. This is the trading range, and we're at the bottom, but this might need a second leg down. And I mentioned earlier, the risk is that we have to test lower swing points. And there's layers of support, and each one of them is a magnet. But so far, here's a bull trend line, and the bears are getting a trend line break. And that's good for the bears, but typically, for a major reversal, you need a trend line break and then a retest of the trend's extreme, maybe the apex of this triangle up here, before we find sellers, and then a possible attempt at a major trend reversal. All right, that's all the time I have for today. Thanks everybody for watching, and I hope everyone has a good weekend.